There is a quiet, terrifying moment in every major market collapse when the noise suddenly stops. It is not the sound of falling numbers that breaks people. It is the sudden, deafening realization that the rules of gravity have just changed overnight. Entire fortunes vanish into digital smoke not because the companies themselves stopped functioning, but because the human beings behind the screens surrendered to panic. Most people believe that surviving a crash is about predicting the bottom, timing the exit, or possessing some rare analytical genius. But history whispers a very different, uncomfortable truth. The greatest investors do not survive because they see the future. They survive because they have mastered the one thing nobody teaches you in school: how to sit completely still while everyone else is running for the exit. If you have ever wondered why some people lose everything in a storm while others quietly buy the wreckage for pennies on the dollar, the answer is about to change how you look at every financial decision you will ever make. Take a moment right now to hit that subscribe button and leave a comment below with your own thoughts, because what you are about to discover might just protect everything you have built. We live in an era obsessed with speed. We want our data faster, our trades executed in milliseconds, and our wealth accumulated by the end of the fiscal quarter. Modern finance has tricked us into believing that motion equals progress. Every flashing red and green terminal screams at you to do something: buy, sell, hedge, rebalance, react. Yet when you look back across decades of economic turbulence, the most enduring fortunes were never built by the frantic. They were built by individuals who understood a profound, counterintuitive law of human behavior. Doing nothing is often the most violent, aggressive form of defense you can deploy. Think about how the human brain reacts to sudden danger. For hundreds of thousands of years, survival meant running away from the predator rustling in the bushes. Hesitation meant death. When the stock market drops 5% in a single morning, that exact same primitive survival circuit fires inside your skull. The modern financial dashboard triggers your ancient predator alarm. Your palms sweat. Your heart rate accelerates. The rational, calculating part of your brain simply goes offline, hijacked by an overwhelming urge to flee. Wall Street knows this. In fact, modern financial systems are engineered to exploit this exact neurochemical vulnerability. They rely on your fear to manufacture liquidity, turning your panic into someone else's discount. The first rule of surviving a catastrophic market downturn is recognizing that your own biology is your greatest financial adversary. You are not fighting the market, you are fighting your own evolutionary wiring. Let that settle in for a moment. Every time you feel the urge to sell out of pure terror, you are not acting as a rational economic agent. You are acting as a frightened animal. True financial survival begins the exact second you learn to decouple your survival instincts from your capital allocation. But how do you train your mind to remain tranquil when the world appears to be burning down around you? The answer lies in understanding the nature of value versus price. Most people treat the stock market like a giant popularity contest, where a falling price means the underlying asset has somehow become inherently toxic. Imagine walking into your favorite local grocery store and discovering that the highest quality, most sought-after steaks are suddenly marked down by 50%. Would you run out of the store screaming that the meat must be poisoned? Of course not. You would load up your cart and smile. Yet when that exact same 50% discount hits the equity markets, human psychology completely flips on its head. People panic, throw their hands in the air, and declare that the sky is falling. Why does this massive disconnect happen? Because we price our investments using our emotions rather than our logic. We let the daily fluctuations of a ticker tape dictate our emotional well-being. The legendary masters of long-term capital look at a market crash through an entirely different lens. They do not see a crisis of wealth. They see a transfer of wealth from the impatient to the patient. They understand that market prices are driven by human mood swings in the short term, but by underlying economic reality in the long term. A temporary collapse in market sentiment does not destroy the intrinsic earning power of a truly great enterprise. If a business has zero debt, loyal customers, and products people cannot live without, its fundamental value remains intact even if the stock price is cut in half. The paper value drops, sure, but the engine of the business keeps running. This brings us to the second pillar of surviving the storm: financial fortress building. You cannot remain calm during a crisis if your personal survival depends on the immediate liquidity of your investments. Panic is almost always the direct result of leverage and poor cash management. When you borrow money to buy assets, you hand the keys to your financial destiny over to someone else. The moment the market dips, your lender calls your margin, forcing you to sell at the absolute worst possible moment. You are no longer an investor, you are a captive audience with a gun to your head. True independence requires a fortress of liquidity. It means holding enough cash on the sidelines that a 50% market drop is not an existential threat but an invitation. Most people view cash as a lazy asset, something that loses value to inflation and should be deployed immediately. But in the psychology of a master investor, cash is oxygen. Cash is the ultimate optionality. It is the fuel that allows you to remain calm, rational, and composed while everyone else is liquidating their life's work at fire sale prices. Without cash, patience is impossible. With cash, patience becomes your greatest competitive advantage. Consider how the corporate world operates during a systemic shock. Weak companies with bloated debt structures spend their time desperately trying to survive the next 30 days, cutting R&D, laying off talent, and begging for bailouts. Meanwhile, debt-free enterprises with fortress balance sheets sit back, observe the carnage, and quietly acquire weakened competitors for pennies on the dollar. The crash does not destroy them, it fortifies them. The same principle applies to your personal portfolio. If your financial house is built on a foundation of solid rock rather than shifting sand, a market crash stops being a tragedy and starts becoming a masterclass in opportunity. Yet, building that fortress requires a level of discipline that goes against every cultural norm of our modern consumer society. We are constantly pressured to upgrade, leverage up, and stay fully invested at all times. Society rewards the appearance of constant motion. Sitting on cash is often ridiculed as timid or unsophisticated by people who confuse activity with intelligence. History looks back and laughs at those critics every single time a major crash unfolds. The people who looked unsophisticated while holding cash suddenly look like economic geniuses the moment the panic hits its peak. This brings us to the third crucial realization: temperament will always triumph over intellect. You do not need a genius-level IQ, an advanced degree in quantitative finance, or access to secret algorithms to build enduring wealth. In fact, many of the smartest people in the financial world, individuals with elite academic credentials and complex mathematical models, are often the first ones wiped out during a crash. Why? Because they trust their models more than human reality. They believe the market can be entirely reduced to a formula, failing to account for the unpredictable, emotional nature of human panic. When the formula breaks, they break with it. Success in investing is roughly 10% intellectual capability and 90% emotional stability. If you cannot control your own temperament, your intellect will only find more sophisticated ways to ruin you. Think about the psychological discipline required to buy when blood is running in the streets. Your friends are telling you you are insane. The headlines are screaming about the end of the financial system. Every logical impulse in your body is screaming at you to stop the bleeding. To execute a buy order in that environment feels physically painful, almost like touching a hot stove. That is why most investors fail. They know the theory of buying low and selling high, but they lack the psychological stamina to execute it when the emotional temperature reaches a boiling point. Mastering your temperament is not something that happens overnight. It is a muscle built through repeated exposure to discomfort, guided by clear, unbreakable rules that you set before the storm arrives. You write your investment philosophy on a clear, sunny day precisely so you can read it when the hurricane hits. You do not improvise during a crisis, you simply execute the playbook you prepared in advance. This leads us directly to the fourth rule of survival: extreme concentration on business fundamentals over market noise. When the portfolio is bleeding red, the untrained eye looks only at the ticker symbol. They watch the price drop minute by minute, torturing themselves with the downward trajectory of their net worth. They are looking at the symptom while completely ignoring the underlying disease or health of the enterprise. An investor who thinks like a business owner does something entirely different. they ask themselves a fundamental question. If the stock market were to close down for the next 5 years, would I still be proud to own this business? Are people still buying its products? Is management allocating capital wisely? Does the company still possess a wide economic moat that keeps competitors at bay? If the underlying business fundamentals remain strong, a falling stock price is nothing more than a temporary inconvenience caused by someone else's emotional instability. It is a disconnect between price and value that will eventually correct itself. The stock market is essentially